Hey folks, glad you could join us on another conversation on Business Redifined. This is your weekly, most comprehensive look at the world of business, finance and economics. Now, last week we had a conversation with Stanbic Bank on the subject of retail banking. This week again, Stanbic Bank, totally different conversation, the sustainability report, and we are privileged to have the man in charge, the CEO, Mr. Joshua Oigara. Karibu sana.
Thank you very much, Julian.
Thank you for your time. Joshua, congratulations on the report. We are in an environment where we are increasingly speaking about integrated reporting, the three bottom line, where we're talking about profit, people, and purpose. Speak to us about your major highlights from the sustainability report.
So the three items you spoke about, Julian, I see it like the Holy Trinity, if I use that as an example. Ultimately, more and more of businesses must be able to build an enterprise that has got impact with the communities that we are operating. That's a massive part. We call it inclusive growth. It's not just about delivering your financial performance, your ROEs and your results. That's one aspect. But how does it touch the communities, the impact for the society we have? How does everyone come to connect? And then finally, how does the team within Stanbic be available to be able to interconnect all those pillars? So when you look at our report, that is the basis. We believe that within environment, within our society, and within the governance principles we have, we're able to build that businesses collectively into the next level of our future. So it's a movement. Now, this is the third report that we've launched, that we have around our priorities and our promises and our commitments. And it's coming out of your global international sustainability standards board saying we now have guidelines for you to be able to build. So that would be a great aspect for us, for our businesses. But the exciting part for us, when I look at job creation, the women entrepreneurs that we worked with, the micro enterprises we've been able to build in the last year, the energy transition and enterprise development we build on, including infrastructure, the financial inclusion measures that which we're going to have as an organization, and then finally, how are we able to build climate resilience in the financing? And we'll speak much later around green financing. And that's what we are looking at as an organization. Now, Standard Bank as a group has committed in excess of $15-16 billion in the next 3 years towards green financing and sustainability. Our contribution as a business is to reach $1 billion as an organization. The Kenyan gap to be able to raise the financing we need in the next 3 years is around about $30 billion. So you can see our contribution is not as significant, but we need to get more allies to be able to succeed in this ambition.
Joshua, $1 billion. And many times when I speak to people in this side of the world, on the green financing side, they will tell you, we have the liquidity. What we lack are bankable projects.
Correct.
Are you seeing a pipeline?
So in the way we look, and this is a fundamental issue that we face in our markets. Today, and I want to agree with you, Julian, there's significant liquidity in the market, which we have not seen in the last 12 months. So from January, if you look at how much liquidity is available in the system, it's astronomical today. But are we moving that into lending decisions for the industry? Which is a key question we are discussing and raising at an industry level. My view is the answer is twofold. So we've seen projects on large-scale projects. So infrastructure, we're seeing energy, we're seeing roads and ports, we're seeing some large manufacturing coming through. And that's at the very top end of the industry. But as we go lower, and some of the bigger projects actually was the financing which was done by the Roads Board to raise funding for the pending bills, which also they have been able to raise more than 80 billion fast disbursements. But as you go lower now into the heart of the economy, your SMEs, the 5 to 6 million of those entrepreneurs, credit has been largely been muted. In reality, it has been negative. So what I would say that we're doing is to build projects, get support, and I would say the things we've struggled with ourselves as an organization and also the industry is that because generally there was delayed payments and the mood within the environment in the economy was very muted, projects were not coming through. But with a lot of issues done now, so three things I would say have also happened in the last, and I salute work done by the Central Bank and the National Treasury. So inflation is more well anchored now from what you've seen. I would say perhaps a bit on the lower side, to be honest, at 3.8%. Your global macros in terms of your exchange rate is kind of steady in the last year. Your current account deficit has kind of narrowed down. So what we need to be able to say, how do we use the market, manufacturing, industry, agribusinesses? That's the area we have not done extremely well. So there is obviously good signs because 2% growth of credit, you may not agree with me, it is too low. Our regions are at 12, 13, 14%, which is Uganda, Tanzania, Rwanda. So the issue is to get ourselves back there.
Yeah.
And Stanbic, the way we work both the foundation and the bank is to curate the business ideas which are not bankable yet. And later on, we can speak about what you're doing with our Catalytic fund, how much we can scale it. But the moment for us in the second half of this year is for us to catalyze growth in the industry. Its credit needs to be able to grow from the current 2% aggregate to double-digit % by September and December.
Okay. Considering the kind of passion that Stanbic exhibits for the bottom tier, if I could call it the MSMEs in terms of green financing, when you talk to the DFIs and other players who are holding liquidity, they will tell you that we're seeing opportunity there, but it's too fragmented, too small ticket size. How does Stanbic now act as a bridge given that challenge?
This is the market where we must build a model of aggregating our capabilities, not just as Stanbic, but within the industry. So we've done well on bigger programs. So there is obviously a way of lending collectively as a bank and as a team. And we've done that strongly well in many projects. If you look at just the ones we've done, like the ports, the roads. On the micro enterprise and SMEs, that hasn't been an area we've worked very well. So there are two issues I would say. We also need to connect the SMEs and improve their access to market. So to give a good example, like if you have farmers who are doing avocados and they want to deliver one container, one farm in a season may not deliver that one container every week.
Correct.
And the client just wants avocados delivered. The client is way down in Shanghai or Beijing in China. So how do we bring them together into some corporations, some societies, some circles? That's one area. Our foundation brings in a partnership with the county government through the Ministry of Trade, through the Ministry of Investment, and saying how do we work with them and give them financing through the programs that we face. I've seen that, and also working with the Kenya Association of Manufacturers, and we've also done some work today with the Kenya Private Sector Alliance. Can we work closely together? So that disaggregation actually loses funding. So if you look at the problems, we are getting $100 million where no one can be able to absorb, and we need $10,000 to $15,000. So that is the granularity that we lack. And I'm saying that with 50,000 SMEs we are working with today, we've been able to work with GIZ to take a bigger program, which is €1 million, break it down to 5,000 euros.
I see.
You see, we've been that's really the way to be able to construct. Yeah. Ultimately, that is how we catalyze them to become. My belief is the smaller businesses of today, which you call as the SMEs, must be supported and catalyzed to become the champions of our market and potentially an African champion in the decade.
That's a good way of cascading it further downstream. And Joshua, let's now pivot now to your Catalytic fund, given what you're talking about. I remember when we were in school, we used to be told that banks have no appetite for patient capital. Here you are with the Catalytic fund, 63 million from what I've seen. How do you intend to scale this? And do you see it as a building block into your mainstream banking?
So the way we've seen financing in that segment of the economy, and I will just come back to what we've done with our data initiative, banking, women-led, women-owned, and businesses today, and women-managed. And the ambition is much significant. We are in the market for $100 million.
Wow.
Correct. So and we can say, let's talk about this a shy of how do you build that capabilities into the market. So that is our bigger vision. And it's not just us alone. And we've learned that if you keep on just focusing on the clients who are ready now, you're leaving 80% of the clients who have capabilities out of the industry. Yes. That's what we've seen over the last couple of years. And my view is that we have to continue expanding the continuum and bringing them in. So we invest the catalytic funding in these businesses, which are new startups or scalers, and that truly have value for scalers. Kenya today has got 5 million scalers in the market. And we estimate that of those 5 million, less than 1 million have access. And I'm not even talking about the startups.
Yes.
Because the startups are in addition of 7 to 8 million. And those ones, the access for funding has not been as solid. So we provide them funding today. Initially, it's a grant.
Yeah.
Correct? And then over time, we then give them some access to market capabilities. We bring in partners like Microsoft for their literacy training. We also bring in GIZ and the work we're doing today with the Gates Foundation to be able to build capabilities for them. Those fundamentals, because business is very intentional, Julius. It's not something you start and then
you must be deliberate.
Exactly. Like anything else in our kind of life. So what I've been excited about is the repayment of those funding has been the highest of 80%. And I asked my team, I don't think we're doing the right thing. Because
at this level,
we expect a 50%
True that.
That is the only way we can intervene in the industry where we're in. And my excitement, Julian, is over those businesses we've seen today accessing more than 30,000 businesses in the last 2 years. And some of them, I have a story of a business which came in and said they're doing a 10,000 shilling startup. And today they're being able to borrow 1.5 million in a period of 1 year. Now, for them, and that's significant, and they're now exporting. So that is the capability that we see. So we're working very closely now with the Gates Foundation with our programs to create deeper financing for the grants and the what you're calling as a fast seed funding.
Yes.
Yeah. And what else will we crowd in? We believe that private capital, because many times we're looking at it as it's only lending capital you need.
Yes.
But those businesses sometimes require long-term.
Correct.
And we've asked these questions many times. Even 7 years, is it long enough to start a 7-year business? Sometimes it's going to take, if you think about the normal business you see in your environment, some of them take 10 years before they can scale, especially in the digital space, manufacturing space. I mean, I saw a farmer who does macadamia. Julian should be surprised. You plant a seed today, macadamia, fast fruits, 7 years.
Jesus Christ. That lead time is long.
Yes, but once you get the 7 years, you can now run that crop for 30, 40, 50 years.
Yes.
See, if I'm giving you a 3-year money, I'm not even helping you build up businesses, but I'm happy that we've supported macadamia farmers with a facility that gives them that financing for their business.
Joshua, on that point, and as you know, this was in a previous life, this was my kind of day-to-day. Given what you've said, are you then, in your Catalytic fund, are you sector agnostic, or how do you approach it?
So today we've aligned with the biggest areas of our economy.
Okay.
The way we see impact, because we're also doing catalytic funding with the impact of economy. Agriculture or agribusinesses is a big part. It is 25% of the economy, or 26%. But actually, in terms of business, it's 80%. If you go out into many areas of the counties, people in agribusinesses, they're doing this, they're doing that. Not just industrialization, that part is becoming lower. So we're also doing into technology. We have some work we're doing into music and art, which we're running, education, institution, healthcare. So we don't really look at, the model is similar, but energy projects tend to be the longest lead time from what I have seen. Even 10 years, if you do your short-term financing for energy projects, they don't always come along. Like if you go in and do your mini grids, yeah, Julian, there are many places today where you still have to deliver mini grids.
That's true.
You may not see them every day if you're in Nairobi, correct?
But they're there.
But they're there.
Yeah.
And they're providing real lifeline and without energy, you may not be able to build any businesses. So we are looking at all aspects in our market. And so the way you look at it as a catalytic fund, which actually revolves. Yeah. So most of those facilities are 1 month. So if I've got $100 million fund, what matters is velocity and churn. If I can turn it quicker.
Correct.
And what then we do is that then the bank off takes. So if you look at some of the 100 billion shillings we've been able to do on energy and trade, a lot of that actually is smaller businesses that we've been able to midwife and promote into the institution. Okay. So that's the biggest value we see. Today, in my numbers, the SME component of the industry is close to 30%. At the time you're looking at it 10 years ago, it was 5%.
Have you been at a point where you have seen some businesses through your catalytic fund and gone like, there would be some good opportunity here for some blend in terms of debt on one side and equity further down the road, given the sort of growth you're seeing there?
So in Stanbic, that is really the next phase of our foundations. I am a big fan of blended financing in these businesses. Yeah. Because Kenya hasn't been, one thing we also need to find solution for is we don't have so much of private equity or family offices willing to put in funding in our business environment. But I believe it's not going to start coming. We see that in Nigeria, we see that in South Africa. In Kenya, we're still much more, and maybe it's because there's so much opportunities in the government. The government, is a big borrower, right? So for good reasons. So
the yield on that side.
Exactly. But I believe that is going to change over time. So I have been able to see businesses where the debt, some of the debts, and I have some of them in agribusinesses today, where part of that debt actually became mezz. Yeah. Correct? Yeah. Which means we left becoming now a commercial lender into more of an equity provider for that business. And you extend it for a period of what could be a 3-year cycle to a 7-8-year cycle. So we're seeing that a lot in the SMEs. What is the areas we need to improve on? On the governance side of those businesses is one issue we face. And also the transition of ownership for family businesses is always a challenge.
Succession.
well, you can call it succession, yes, but giving my creation, right, and bringing somebody else like Joshua to come and tell me how to manage this governance isn't the easiest conversations we're facing in our market. But we see that across. If you look at just big entities like WhatsApp, these were younger developers, created a business, curated it, and when Meta came in a few years ago, they catalyzed that business with the market that they have.
Yeah.
But sometimes we hold so much on the family businesses as the crown jewels. I come from a generation where, fortunately or unfortunately, this generation is the one that's creating the fast capital for their families. So you can understand why they're so cautious.
True that.
Because you're talking a real crown jewel, actually. Because if they're not, they didn't receive this they got education from their parents. They didn't get capital. You created the fast capital of, let's say, $100,000. You don't want to lose it to someone. You have a chance to take it to $1 million or stay with it. And what happens mostly? It stays. So
capital preservation.
Exactly.
Joshua, you and I need a separate conversation on capital structuring. We shall reserve that for another time. Let's go back to the report you've just released. This is your third edition. And importantly, it comes against the backdrop of a time when we have had the ISSB come to Kenya to launch IFRS S1 and S2. Speak to us about the change that has had, or the impact it has had on how you're looking at your integrated reporting.
So this is extremely, for me, historic. That you're looking at the International Sustainability Standards Board coming up and saying, now there is kind of a benchmark. And this benchmark needs to be taken into your integrated report. So in reality, Julians, we're going to move away from having a separate report to getting your financial statements, having your governance positioning, having your sustainability, which I believe is extremely the right way to do. We can be comparable, correct? We also now have enough models to stress test the environment where we're in. And also, we'll be fighting around issues today around greenwashing. And we can speak about much later on. So it's going to be, I would say the first year will be much more challenging. Because of the disclosure requirements, the reporting information, the matrices you're going to be able to have. And remember, it's a new chapter in the integrated report.
Yes.
I'll give you a good example. Our report today, integrated report, is almost like, last time I checked, 300 pages, 250 pages. Sustainability report by itself is another 80 pages. There is no way we can take 80 pages and condense it. So we have to be quite cherry-picking what you're going to be able to do. Number two, it really enables us as an industry and as a market to access global capital. This is something that we've lacked. If you ask myself, why is FDIs for private sector not as high? Investors are asking these questions, and can I see a benchmark? How is the Kenyan business comparing with other areas in the globe? And this is what I value most. But Kenya, in summary, Kenya is well known to be a champion of standards. If you remember in the early 90s, early 2000, we were among the first adopters of the International Financial Reporting Standard. You remember IFRS?
Yes.
Correct? And we were ahead of Europe, we were ahead of North America. I believe that this will be, in my view, the lessons are there, the skills are available today. We've been doing our reporting for the last three years, so we build 3-4 years of data. So it's exciting for us as Stanbic. I know that we don't have to fight for perfection. If we can get the entire industry and the entire private sector to adopt the standards, it will be a greatest moment for our economy to bring in new capital.
And certainly you're one of the market leaders there. But many have asked the questions, especially when you talk about IFRS S2 and the climate risk aspect. How does an entity like Stanbic then begin to model out climate risk, given how outsized it can be sometimes? We don't even know the scope of the risk that we are dealing with, especially when you're factoring it into your lending. We have seen you have engaged in some sustainability-linked facilities.
Correct. But remember, this is an area we've spent enough time. And to be honest, the risk is quite dynamic. And it's very broad. We haven't even started chipping into where we can land a position of excellence. And I would say when we did, it was a 15 billion shilling sustainability bond or facility loan we issued. This just tells you about, and this was a very large corporate organization.
Correct.
But if you want to go lower to the farmers, guys supplying coffee, supplying tea, there's a lot of difficulties in there. What's the framework? And I want to talk about the framework issued by the central bank and also the green taxonomy guideline issued by the central bank. What it does, it has given us enough parameters to guide and describe or classify where we are able to play at. So that for me is a fantastic opportunity. So even how we look at our risk modeling today, what element of climate risks, even if they are physical risks, Because remember, we see that as a big impact where we are today. How much of that impact are we factoring in as scoring models?
Yeah.
What are we doing in credit assessment of our clients? What covenants are we bringing in place across the different sectors of the economy? And we've struggled in the last few years where you can use public information to be able to position project as green.
Yes.
Correct? And that's an area the central bank has been very clear that we need to be able to classify what really qualifies. And I believe that it would be great to, what it actually do is to enhance the amount of investment, lending, and capital being put in these sectors for green lending. So that was big. We've seen some in agriculture, we've seen some in, look at our energy projects.
Yeah.
Most of these ones, I mean, if you look at a project like the Expressway, many people don't understand that this is a green project.
Yeah.
The amount of energy and emissions you're saving by being on that road
Yes.
for a few minutes, vis-a-vis if you're stuck.
On traffic.
It's unfortunate if you're stuck on the traffic downstairs. So that's the model I'll give to you. And we also need this. We need to train our people to be able to identify where we're intervening for those green lending projects in our market. Today, less than 8% of our total portfolio, we can say, qualifies. Our ambition is to take it to 20%.
Wow.
Yeah, 2027.
It's quite ambitious. Let's speak about the end-to-end and the fact that the central bank put out the green taxonomy. First of all, just help us understand why this is important for the banking sector. And curiously, on the subject of greenwashing, because if Stanbic Bank gave me a loan today, how does Stanbic Bank ascertain that my final use of the proceeds are actually ticking the box as far as green lending is concerned?
I mean, I must say that central bank has done tremendous. So it's a discovery stage. It's a very complex area, but we have worked very well with the European Union taxonomy for a couple of years. So we are slightly ahead as Standard Bank and Stanbic. But Central Bank came in to give a point of clarity and a clear classification. That's one issue that we believe today, not everybody can wake up and say, my project is green. Yeah, it's like you have a rubber stamp. So yeah. I could say there was lack of transparency, or there was also ingenuity. There was no ingenuity in the way they were able to invest. So that is what the taxonomy gives the guy. So it's a good classification model about what gets, what doesn't. Number two, you ask a very good question. How do you link into the end user? Yeah. I can give you you're a coffee farmer, I can give you some money today, but what you're doing actually has nothing to do with coffee. So the screening process we build ourselves for each, we look at end to end, from the architect with the anchor partner to the end user. So we follow those processes, not just by ticking a box, by visiting them to see where they are connected. And actually, this is why sometimes we haven't increased our lending portfolio as much as we needed to do. So 8%, 9% is still very low compared where our ambition is going to be able to go to. But once also the industry does that, what you will to drive to is we've got now a new marketplace where more people will want to be crowded in than before. So actually, if you're the one saying that I am doing a green project and you're not, most likely that space will start shrinking. This is what the taxonomy gives you some guidance. And then also gives you some clarity around how do we screen and score. Because remember, it's one thing to have a guideline and then you achieve no preferential review, no financials, no longevity of your financing facilities. So I give you an example of a farmer. If he wants a 3-year waiting period, if I give him a facility for 1 year, this farmer cannot function. So this is the area we are building. We are glad having worked with the EU taxonomy before, but we have to get this thing embedded, and so we're way ahead for ourselves as an institution.
I see. Joshua, given your vantage point, just how much of a problem is greenwashing in the banking sector, or in Kenya by and large?
So, greenwashing, I would say, from my view, so the industry at something like 4 trillion in terms of actual amount of loans. For our perspective, we don't think that it's as significant. So I'm saying it's more about in the 25% range. Yeah, it's on the lower quartile. Yeah. Because remember, our lending generally into this segment has been very limited. So there could be part of that lending coming in, but not from our own institutions. So what we need to do is to bring them in the transition risks. How do you crowd them in the way we are providing finance? So I wouldn't say that it's been as significant, but the loudest promoters and in terms of green financing, most of those projects had nothing green in them. And that is the greatest risk we face in our market. So we salute the work, the clarity done by the central bank.
Josh, I'm being dialed down on our time, but I can't finish without asking you a question about job creation, and especially targeting the youth demographic. We are all conscious of the kind of environment we are in as a country. We have seen the developments in the recent past. What is Stanbic doing around that?
So I would say two main areas for that question. It's the most historic questions for my generation. So it's one way about how we see jobs. So we see jobs because of how we trained our people into a much more blue and white collar jobs. But there's a lot of work which is being done with SMEs and micro enterprises that is always seen as informal.
Yeah.
In reality, actually, it's not.
It's not informal.
It's not informal. That is the real job that our teams have. And I'll give you an example of what I've watched in countries like Jamaica, when they were able to, and it's a huge tourist destination, actually, for Americans into the Caribbean. And the amount of jobs they created in the hospitality industry, those jobs count for the national average of jobs created. It's $200-300 a month. Now, we have to find a way to work within our SMEs to give them support, give them the funding, give them the logistics that they need, and access to market. So fundamentally, some of our young people, especially technicians, so the investment you're making on your digital centers, your technical schools, a number of those skills, unfortunately, go into doing just selling stuff on the street.
Yeah.
So that's not what we want to be able to do. So I would say there must be a way to, there's no need of formalizing them. We have to acknowledge them as a big part. It's more than 13 million of jobs are in that segment of the economy, vis-a-vis 3 million formal jobs. Yeah. So where is the real aspect? Is there. So what we need to do from a bank, our ambition is to more than double our lending portfolio with SME. Today is just shy of 20 to 30 billion. So that's 5% of our portfolio, right? So how do we make it more significant? But also we have to build some training and capabilities. And what I love most about our approach is you don't leave the small enterprises by themselves. How do we anchor them in the ecosystem of the large organizations? And I'll give you a very good example. If you're dealing with the large institutions today, and let's assume that you're even the pipeline, there are so many people involved in the transportation, involved in the safety of the valves of the pipeline that is coming in, the storage. How do we make sure that they are, the way we find solutions for the pipeline, there are more than 20,000 small businesses in that segment. How do we engage them to the same quality of candor? And that's what we have to be able to work on, Julians. Is it a chance? Can we build more jobs, 3-4 million jobs in the private sector in the next 2 to 3 years? Definitely we can. I have no doubt. But we must give solutions. So again, the smaller businesses are always harassed. So my meeting and conversation with the minister is to, and actually had a conversation with the chairman of KRA, is to say somehow there must be a way of engaging them to find a solution for how they operate. The operating environment is the biggest challenge for them to be able to thrive in their business.
But Joshua, the skeptics there would say that if I go to a bank like Stanbic, scouting for a loan, and I'm in the gig economy as they're called nowadays, they will ask me for bank statements to show my paycheck and what have you. I don't have a paycheck.
Correct.
I'm in the gig economy.
Correct.
Yeah. So are we going to move away from collateralized lending by players like yourself?
By the way, we have done significant, Julian's, investment in using digital information to create a very robust scorecard, which has got a good robot that creates I call it an algorithm. Yeah. So you don't have to give any document. Today, Julian's, even before you coming up, we have a view. If you just come and say...
Oh, my credit worthiness.
We do. We do. It's available. It's, even for SMEs. Now the question is, okay, does it fit the purpose that you're looking for it? Yeah. And our ambition today is how do we continue to enhance that model? What we have found as a limitation. So today we are doing lending based on the data points that you have. And in reality, what we have seen in our experience, and we learned that from the personal lending, that security or a real asset does not predict well that the client will return the loan they have taken. But his cash flow, his business models, that is what it's going to be able to build. What have we lacked before? I would say 3 things from our organizations. Actually, we've been very successful. Our SME business turns around its business, in my view, 3 to 4 times a year, the velocity. Yeah. So I may have a 10 billion shilling facility, but at the end of the year, it's a 30 billion. That's one issue I would say. What have we struggled with? Registration. You can imagine, Julian's, there is a lot of challenges in registering, and especially on a tax perspective. When you hear KRA saying we have a challenge of how many people are registered, and we have to find a way that to make it easy for them. And I understand my SMEs get they're very afraid. Very, very afraid. I've seen smaller businesses being harassed every single day, and I speak this because we've had conversations with the tax chair, the tax authority chair. So that's one area I would say we need to be able to do much. And number 2, give them a longer term business. And my question to SMEs which we funded, I've seen people who make cupcakes. I've seen people today who are coding companies today, setting up their own new businesses. That's what we've been able to build on. But I will also agree with you that as an industry, we have a lot more
to do. I followed through your sustainability report. Quite stellar numbers, stellar impact. Are you looking to tap into some funding from some DFI, given the sort of numbers you're putting out in your sustainability?
So the way we work as an organization, a lot of our funding structure is very much coordinated within how the group has operated. So Standard Bank, Africa's largest bank by far.
Yeah.
And so when we set up programs to enhance our sustainability, we set up a mechanism to raise funding. So when I spoke about a bigger program for $16 billion towards energy transitions, job creation, enterprise development, financial inclusion, and climate finance, it's within that cohort where and we've raised, Julian's, of that, already raised 1/3 of that, more than $5 billion already raised. So remember, it's not just a Kenyan kind of lens. We are doing a delivery within 20 to 22 countries on the continent. So that's just the direct answer, but we've been able to lead. And so we are naturally a fundraiser for the continent. That is one thing that I can mention to you. Think about bigger projects. We've been able to be a very big investor into them. But for us in Kenya, we are looking at programs to be able to give us funding from your development organizations, especially for what they call the nano entrepreneurs, smaller, the micro entrepreneurs, and the medium enterprises. So that is the next level, because now we can, and also with our sustainability reporting and the standards, we have a global benchmark. We also will look for accreditation, like from a green climate, finance institution, to say, are we benchmark able to get that funding? So looking forward, our ambition is that's where it's going. We are not there yet, but in our $1 billion commitment in our market, part of that financing is because of financial sustainability. So you're absolutely right about the ambition.
Fantastic. Unfortunately, folks, we have to close our conversation at that point. We've been speaking to the man in charge of Stanbic Bank, Joshua Oigara, touching on the sustainability report on a raft of issues, including how the small entrepreneurs can tap into the opportunity of green financing. He assures me that when the half-year numbers are out, we shall be able to sit down with him. Rather, when the next earnings cycle is out, we shall be able to sit down with him and unpack all the digits. So stay tuned to Business Redefined.